Most trading mistakes are not entry mistakes. They are context mistakes. The strategy was fine, but the market condition was wrong. So beginners obsess over buy or sell because that is the visible part of trading. But the bottom is that the least important part of the decision. I mean, pressing the buy or sell button is not important. The real question is whether the current market fits the strategy you are about to use. So that matters because strategy is not a belief system. It is a tool. Any tool, it only works well in the condition it was built for. Use a trend following method in a choppy range, you can be chopped out, and use mean reversion strategy in a strong trend, you can get run over. So before you ask where do you enter, ask a better question. Should I be using this strategy here at all? If the answer is no, the rest of the trade does not matter. So a complete trade should be built in sequence. First, define the market condition. Is it trending, ranging, volatile, or quiet? Then define your directional thesis. After that, for an entry trigger, then set the invalidation level. Then determine position size, plan to exit. That order is not cosmetic. It is what keeps you from forcing a setup just because price moved. So this is where you will open up the chat and execution link. So this is for gold chart. Normally people will scalping and trading in very high fast time frame, which is 1 minute or 5 minutes. But in order to determine the trend line, the overall directional bias, we normally have to use a D chart because the time frame need to be slow enough to get the overall trend. So as you can see from here, look at the day chart, we can draw a trend line, very simple trend line, and it shows the directional bias is the downside. So the price of gold price is trending down. So that's the overall trend, and it will dictate the market condition before you enter the trade. And also you can look for the invalidation level. Also they are the entry level, because when you define the entry area, it also requires you to put the stop loss around that, and the stop loss level will show where you can validate your invalidate your entry. So let's say you enter this region, if you trade, you enter this region, so your stop loss level is around here. So if the price go up and break this level, you can say that your thesis is no longer valid. And yeah, meanwhile, you can have another stop level in the other area. It depends on where you enter the trade. You always have that kind of invalidation points. So it turns trading from a reaction into a process. So as a simple trend line can help with that first step. It does not predict the future. It just tells you whether the market is behaving in a way that supports a trend-based approach. So if price is respecting the line of momentum, a trend following strategy may fit. So if the price is chopping around it, the environment may be too noisy, that's the same approach. The point is not that the trend is magical. The point is that it gives context before execution. So a practical framework for one trade is simple: market condition and directional thesis, entry trigger and invalidation level, position size, exit plan. That framework matters because it separates decision quality from outcome. A trade can lose money and still be a good trade if the regime matched the strategy and you respected the invalidation. So a trade can make money and still be a bad trade if it only works because of luck in the wrong environment. In the simple trend-based framework, the best entry is often near the trend line. So where price is relatively favorable and you are less likely to get stopped out by chasing the extension. So and the invalidation should be obvious. If the trend line breaks, the thesis is wrong, and that does not mean that every break is meaningful. It means that you have defined in advance of what would prove you wrong. Without that, the trade becomes an opinion with no exit discipline. So a lot of trading errors are not prediction errors. They are context errors. And traders use a strategy because it worked recently, because the chart looks attractive, or because they feel pressure to act. None of those reasons is durable. The better habit is to ask whether the market condition matches the conditions under which the strategy was designed and tested. That is the real filter. It keeps you from forcing trend following in range and mean reversion in a trend, or overtrading in noise. And then position size becomes a consequence of conviction and risk, not emotion. If the setup is clean but the regime is only partly supportive, size should be reflect uncertainty. So if the regime is aligned but the invalidation is wide, or liquidity is poor, size still needs to stay modest. So good trading is not about making every idea work. It is about surviving long enough for the few durable edges to matter. Buying and selling are easy, but the real craft is knowing when the strategy belongs to the current market and when it does not. Judge the regime first. So in the next videos, I will show you how to can do the position sizing, because it's the hard part. It's not easy for a person to trade with the appropriate and suitable size. Thank you for listening.